Good morning, I'm Chris Beach and welcome to Charting the Markets on IG Live. It's a bit of certainly a quiet start to the day, really, although European markets perking up significantly in early trading, rallying off their lows, maybe beginning to show signs of stabilization at least. While there's not much in the way of data, although we had UK GDP this morning, which was weak at best, although it wasn't particularly worse than expected, which at least helped to stabilize things after the volatility of the pound caused by the Bank of England yesterday. It really is a day that we're focusing just on the US debt ceiling. We should have had a meeting between the president and various other senior leaders in the US regarding the debt ceiling today, but that's been postponed to next week, although discussions are continuing over the weekend. So there are signs of progress, but of course we've only got about 2.5 weeks until the 1st of June, when officially the US is meant to start running out of money, heading into what you might call default territory, which clearly is being viewed as a negative by markets. So we had a bit of weakness yesterday, sparked partly by that, partly by the resurgence of the US banking crisis. PacWest Bancorp, the latest bank to fall under the microscope, reported fresh outflows and had to pledge more of its collateral to the Fed's deposit scheme for those banks. So coming under pressure, and again as well with initial jobless claims rising, there were signs perhaps of an economic slowdown, which markets took slightly badly. But we did see a recovery in indices in the latter part of the session and into the evening and overnight. FX markets relatively quiet this morning. The main focus, of course, has been central banks the last 2 weeks, and that now clears for the time being. Not much movement really. As I said, the UK GDP data, the only real event of note this morning. We get Michigan confidence data in the US this afternoon, but nothing else really. And then in commodity prices, gold under pressure a bit yesterday, and oil prices again falling once more in early trading. Really, they've turned lower over the past 3 days, and does suggest that perhaps we have more downside to come in the meantime. But starting with the indices, beginning with the FTSE 100, currently trading at 77.66, and that's off the lows of yesterday's session in what could be a bit of a theme really for indices this morning. Certainly you have seen it stabilize around that 50-day moving average. Dips below it, as we saw at the beginning of May, and over the past 2 days have found buyers. So the 7700 zone coming in for the time being as a potential support really. So that's one area where you may see maybe some buying pressure to come through. Although it has to be said, you can see how we've still got these sequence of lower intraday highs over the past month or so. The past 4 weeks really, so that needs to be broken with a move above 7800. Daily close above 7800 might bolster the view that this pullback here has been stalled and is now preparing to move on to challenge trendline resistance from that record high excuse me, in the early part of May. And then obviously beyond that you've got the April high 79.30, 79.40, which of course was the lower high following on from February's high, which is the slightly more bearish view for this index at this point in time. But overall, so long as we continue to hold above 7700, then we have to suggest that maybe we're just seeing a bit of recovery here for this index. Otherwise, below that, and clearly we could be pushing on down towards the 200-day moving average or even further. And then you've got, as I said yesterday, trendline support coming through all the way from the October lows. That would be an interesting area to watch if we do get that far. The DAX as well, 4 days of losses, or at least unable to move higher, shall we say. And really, I mean, it's getting a bit dull now, isn't it, really? We're still holding about 15,700, but not able to push on above 16,000. We were seeing some early strength in the French index this morning, and that appears to have spread across to other European markets this morning, which means the DAX could be minded to make another move on 16,000. Of course, if it does clear that, that really then opens the path to reclaiming the territory from the end of 2021, and that would mark a remarkable achievement for the DAX. You can then put a stamp on it and say we've recovered all those losses for 2022. As you can see, we've gone from 12,000 to 16,000. Very impressive rally. You might not be surprised to see some sort of consolidation, which is exactly what we've had over the past month. The price moving sideways since the middle of April, down towards 15,700, back again towards 16,000, but not able to break that range. We're looking at another attempt to break that. We shouldn't get too excited, because it would be entirely within the realms of possibility that the index is unable to break above that for the time being. And certainly if it does, the next big area to watch just becomes 16,300 essentially, and the peak from November, December, and indeed January of last year. We've marked the round trip for the DAX, really. And even with FTSE 100 having pulled back a little bit this week, the DAX essentially has gone nowhere for the best part of the month and just consolidating after its impressive gains during the course of March. So really, you can't make it out to be particularly bearish. I think just because it stopped going up doesn't mean it's going down. And so that's what we've seen, is that buyers have been willing to step in, even on short-term weakness around 15,700. So you'd have to see a move back below that to even suggest that the deeper short-term retracement is in play. To the Dow, to everyone's favorite index, of course, back above the 100-day moving average. For the second time in 2 weeks, really, we've seen it dip below the 50-day moving average and then recover. That's exactly what we saw yesterday. Back above the 100-day. It's still a little bit of effort required to really transform this one, because you can see how the FTSE and DAX have moved higher over the course of this year. Let's just open up the time frame a bit. But the Dow remains firmly off the highs, not just of January, of course, but even further back into November. So that's a bit of a problem for this index at best, really, that it really has struggled. Notably, of course, the gains in US markets have come this year from tech stocks, and specifically the big tech stocks. Without them, US markets would be much poorer for in terms of performance, and that's why you've seen the small cap index suffer so much. US markets just lagging behind in a way that they haven't done for quite a long time compared to their European peers. So while we're used to a world where US markets go up and everyone else sort of follows meekly behind, that's really changed over the past 6 months, and there's no sign that that is actually going to go back to where we were, I think. And there's a lot of concerns that because it's just really tech that has gone up to start with, this rally is lacking legs, which is sort of true, but it could also be the case that maybe everything will play catch up over the course of time. But with the debt ceiling playing out, that's obviously going to be a major hurdle for US markets to negotiate. Anyway, back to the chart itself. It's just the fact that since we talk about the DAX not going anywhere for a month, well, the Dow finds itself roughly where it was in November of last year. If you look at the high, the very, very peak from the middle of December was 4% away for the Dow. And then if you look at maybe a more interesting area, 34,500, that's about 3% away from where we are now. So it could do that in a couple of days if it really wanted to, and we'd still be no better off in terms of making higher highs. The fact that for the time being, as I said, for the DAX, it's not going down is a tick in the bullish camp for the time being. For the Dow, it has recovered from where it was in March, and it has shown an attempt to keep pushing lower. But as we can see here, the dips towards 33,000 have just brought out the buyers with no sign that that's really changing. So you can see the trends in the DAX. Ultimately, that's the strongest index at the moment, FTSE 100 taking second place, and the Dow out of these three lagging firmly behind it. It's not very often you've been able to say that over the past 10 years or so. And turning to FX markets, Eurodollar finally seeing a bit of retracement here, bit of a pullback in what is still very much a broad uptrend. The pound also really knocked back yesterday by the Bank of England. You did have obviously an initial bounce for the pound with the news that they'd raised rates by 24 basis points once again to their highest level in 13 years. They'd even upgraded the GDP forecast for the Bank of England for the UK as a whole, and so that we wouldn't hit a recession this year, in what is probably a commendable example of central banks changing their view as the data changes. So whilst they've got a bit of stick for changing their mind, I think actually you should be praised for this kind of thing because your willingness to change the view. Anyway, what might have been seen as a fairly positive day for the pound against the dollar, as we'll come to in a second, was not. And if they're also looking at dollar CAD in a second, really reviving the uptrend here potentially because of most of that weakness in oil prices. And also, it's a bit odd to see the dollar rallying with so much talk of the debt ceiling, but if it does go to a showdown and a crisis, then it will be safe haven moves, and the dollar is the initial beneficiary of that, paradoxical though that might seem. Anyway, euro dollar back at 109. It's declined for about a week or so. If you think again, in terms of percentage gains, we're up 5 and a bit percent from the March lows. We're now off by about 1.5%, maybe come up to 2% now. So really a modest decline after a decent rally, not quite as impressive clearly as the October to February rally, but still there is your uptrend, your higher highs. We eked out finally a higher high over the course of the past week, just within a whisker of 111. Now we are actually below trendline support from those October lows now for the first time. So that's an interesting development, really. The fact that maybe this trend line is starting to come under pressure. But you've also got the 50 and the 100-day moving averages that might provide perhaps an area of support potentially. So it's just one to watch, really, that we're seeing perhaps a pullback in this risk asset, for example, just as the debt ceiling crisis begins to rear its head. We could see perhaps the broader retracement course takes us on down towards 105, but we're not thinking about that at the moment. I think we've got a bit of ground to lose first before that happens. Otherwise, rebound above 110 and you're back in uptrend territory. So that's one to watch here for euro dollar. Quickly to the pound, stabilizing, excuse me, after yesterday's falls. The next destination here to watch is really 124, which was the big area of resistance in December and into January, and indeed also applied earlier in 2022 as well. So that's your first area to watch for. Of course, we've had a higher high this week, the highest level for the pound against the dollar. Sorry to keep zooming in and out, with the highest level there since May of last year. So a 1 year high for the pound against the dollar. In fact, we just eked out its highest level since April, to be accurate. So higher high very much there, uptrend intact. We've not really had a pullback in the pound against the dollar in cable since the beginning of March. So maybe we'd overdue one in that way that market analysts say to try and sound smart. Something's gone up a lot, it's probably bound to come back a little bit. We don't know when. This could be the beginnings of it. And in that case, maybe the initial point to look for would be trendline support or further down towards the 100-day moving average. But the uptrend is still firmly intact unless and until it goes back below 118, really, and then the view changes dramatically, I think. And it's also dollar CAD where a lot of the interest is, because this has been frustrating for a lot of people because it's an uptrend, but it's been a very choppy one, to say the least. And the struggle for dollar CAD has been to actually try and move higher on any sustained basis. But what is interesting is that we've dipped into this wide area of support. This is what I mean about support being, it's not just a line in the sand, it can be an area, because you can just see that dips into this level, and this is why wide stops are always a good thing for traders generally. The dips into this level do provide buyers, but there's no exact area where you can definitely say if it goes below that, then it will start to fall, because you've just seen it dip towards 133 or so, or even a bit below it, and then it recovers. Crucially, we're back above the 200-day moving average. It's oil weakness that's really driving this. So recouping almost all the losses from last week, which puts us in mind of a move towards 136 or maybe even 137 over the course of time. It is, as I say, a much broader uptrend here, just a very choppy one. So just be aware of that if you're trading it, that it could be one that throws you around a bit. You often see that, of course, with these currency pairs. They do have decent trends, but they can be quite the wild ride in the process, so just be aware of that. But the dip into this level suggests that maybe the buyers have regained control for the time being. And finally, turning to commodity prices, precious metals coming under a bit of pressure. Gold, as you can see, dropping back towards 2,000, just heading towards, as we can see on the chart there, the rising trendline support from the March lows. So that's an interesting one. The short term, as we were talking about earlier in the week, you've got really obviously three views: short term, medium term, long term. Short term, the fact that it holds above this trend line is still bullish. If it goes back below 1980, then you could regard that as broken, and the short term shifts to bearish. But you've got, of course, the broader picture, which is the medium term bounce, even the longer term bounce now from those November lows, that would suggest maybe a pushback down towards 1950, 1940, and the trendline support, possible trendline support from those November lows. That would be quite normal, I think, for gold, because you've seen a very big rally. In fact, if you looked at silver, it's even more dramatic, a much bigger bounce and a much more dramatic pullback over the last couple of days, but still in an uptrend. This is still an uptrend as well, higher highs and higher lows. One to watch as we head into the weekend, whether this short-term trendline support will be tested once again, and whether the price can hold it perhaps as the new week gets underway. And then finally, crude oil. This has been an interesting one because you've had obviously a huge drop during April and May, wiping out all the gains made from March, and indeed, of course, wiping out that gap higher from the OPEC production cut. And then it rallied 4 days in a row, hit a wall around 73.80, and now appears to be declining once again. So looks like the sellers still firmly in control here. Again, it's been a volatile one, really. It's finally moved to the downside in March after months and months of ranging price movement, and then just when you thought it was going to really develop into a big move, it then rebounded, but we're back to where we were, and a small recovery, but just you saw that decent bounce, and then the sellers coming back in again to hit this one, which does suggest that we're going back towards this again 65 zone, which is a big wide zone of support. So it could be volatile in there, very hard for battle between buyers and sellers. You can see back in 2021 and indeed in March, so that's the area to watch if we do get back there. But it's really hard to muster up a bullish view on oil in the near term on a price basis unless and until you see it back at least above the 100-day, and then to try and challenge the 200-day moving average once again. So we're just Michigan confidence on the data calendar for the day, and not very much in the way of earnings at all. Essentially earnings season with a few names over the next couple of weeks, but we are very much winding down now with the big names out of the way. It could be a quiet end to the week, but with the debt ceiling expected to really dominate from here, there is a potential for volatility, so be aware of that as we head into the second half of May. It's expected to be a more positive open for US markets following the lead set by Europe this morning. The Dow expected to open the day around about 140 points higher from yesterday's cash close. But that's it for me. Of course, we've just got the week ahead this afternoon, and then we'll be back as normal with the early morning call at 7:30 on Monday, and then charting as normal again at 10:30. That's it for me. Thank you for joining us, and have a good weekend.